Welcome to the Dirt on Real Estate, everyone. This is a Utah-based podcast where we get down and dirty with everything you need to know about buying, owning, and loving your first home. Today's show, we have a great episode ahead. We're going to be speaking with Casey Bentley. He is a mortgage officer here in Utah, and we get really specific on mortgage insurance, or as many of you may know it as PMI or private mortgage insurance. After we talk with Casey, we head out to Mapleton to tour one of Edge Homes' single-family homes that was actually just featured in the Utah Parade of Homes this year. It's a beautiful home, so stay tuned for that. We're going to start off real quick with just some mortgage news. I just wanted to give you guys the current national averages for mortgage rates right now. So the 30-year fixed rate is 6.81% and a 15-year fixed is 6.05%. Obviously, those are national averages and they differ for things like FHA, your credit score, how much down payment you have, all of that. But that's your update for today's average mortgage rates around the nation. Let's jump in with Casey and learn about PMI or mortgage insurance. Thanks for joining me today, Casey. Super excited to talk with you today about mortgage insurance, or what some people might know as personal mortgage insurance or PMI. So that's kind of what we're going to get into and explain the basics of. But for those that maybe didn't watch the first episode that we had on, could you give us a little bit of your background real quick, just a minute or two?
Yeah, so I've been in the mortgage industry about 5 years. I got my license about 5 years ago, and it's been awesome. I've used it a lot on the personal side to personally buy and invest in real estate, and so it's been awesome there to research all the different products, but also it has led me to research a bunch of different products to help everyone else in any way that they're trying to get into real estate. Investment, second home, primary, whatever your situation is, we can usually make it work. So that's a little bit my background.
Well, let's just hop right into it today then. So today we have a more specific topic. We're going to really dive into mortgage insurance and what that entails. Maybe let's just start out. What exactly is PMI or mortgage insurance?
Yes, so back in the day, I've been told, this was way before I was born, I think, you used to need to have 20% as a down payment to even buy a house. Like, they would not let you buy a home if you had less than 20% down payment.
How did anyone buy a house?
Well, to be fair, homes, I guess, were probably $60,000, so that probably helped a little bit. But then I actually don't know when this changed, but recently there was these companies that came out, and they're mortgage insurance companies. They went to the mortgage investors and the companies and said, "Look, if you have people that want to buy a home with less than 20% down, we'll cover the difference. So we're not going to cover the whole the whole difference, but we'll cover 15% of it." So that allows people to only need 5% and sometimes 3.5%, because these mortgage insurance companies are insuring that gap to get you to that 20%. So it really didn't change anything for the mortgage company. I mean, it did, because now they can do a lot more loans, but it's just another type of insurance to help cover in case the house goes down. And it actually, I think, is more for the banks and the investors than it is for the buyer. But it also helps you as the buyer because you can get in. But if your home goes down in value, it doesn't really do much for you. You still just are in that same situation. So that's kind of the general idea.
No, that makes sense. I didn't realize that there was a time that you actually couldn't buy a house if you didn't have 20%. I thought it was just standard.
Yeah, well, from my understanding, yeah, so it's kind of crazy to think about, but
Yeah, that's totally crazy. But that was a great explanation of why it exists and where it came from. Let's see, this might be a little bit of a dumb question, but I'm going to ask it just in case some other people are wondering. What's the difference, and you kind of touched on it a little bit already, difference in mortgage insurance and just homeowners insurance?
yes.
I don't know if you get that question, if people ask, like, is this the same thing or is it different?
No, I get that all the time because they just hear insurance and it sounds like, okay, why am I double paying for insurance? So homeowners insurance, that's what covers if your roof floods or if there's a leak or any damage to your home. That is through a different insurance agent, and they specifically cover any damages to your home. And there's also different policies that can cover like your inside, like if your fridge breaks, if your TV gets destroyed, if your stuff gets stolen. So that would be homeowners insurance. homeowner's insurance, that is a monthly payment as well. So as I'm calculating payments, I do usually throw in an estimate for homeowner's insurance. Then on the other side, there is mortgage insurance, which only applies if you have less than 20% down payment. So then that is another monthly payment that adds to your monthly mortgage that you pay every single month.
So then, roughly how much is mortgage insurance on a monthly basis? I don't know, say on like a $500,000 home.
Yeah, so it's kind of percentage wise, so it's usually between about 35% to 55%. So on a $500,000 home, you're probably 200, maybe 220. Like I said, if you go and take that and times it by 35%, see what number you get. Well, let's just see. But that's kind of the percentages that if you're ever trying to calculate it. So yeah, about 170 to 200 depending. That's on the lower end. I think the higher end would be about 200, 220. 35 to 55% if you're trying to calculate it on your own is usually a good range to do.
Is that of the loan value?
Yep, that would be the loan. So if you are looking in the 500,000 range, you'd want to find your loan amount, which is just you just minus your down payment, and you just multiply that by about 35 to 45%. And then the number it gives you will be a yearly number, so you'll just have to, like, it'll come back as like 2,500. You obviously then you just divide that by 12 to give you the monthly.
Sure. That makes total sense. Awesome. You kind of said it already, but a buyer is required to have mortgage insurance anywhere under 20%, correct?
Yes, so an asterisk on that. Was that your full question or was that?
Yeah. So when, I guess for a full question, when is a buyer required to have mortgage insurance?
Okay, yeah. So asterisk on that statement I said. So if you do a conventional mortgage, then that statement is true. You only need mortgage insurance if you have less than 20% down payment. If you're doing an FHA mortgage, you could have 50% down. Like if you're buying a $500,000 home and you're putting 250,000 as a down payment, you're still going to have mortgage insurance. FHA, it is a permanent monthly mortgage insurance. The only way to get rid of it is to refinance into a conventional loan.
That's a great clarification because I don't think a lot of people know that.
Well, a lot of people right now, I've personally been saying, let's get you into an FHA because the interest rates are a little bit better. The down payment is 3.5% instead of 5%. So it's great to get you into the home. And then the idea is that as interest rates hopefully get better, by the time you build that equity and now you're at that 20% down payment range, we can just refinance you into a conventional. And by then you've paid down some principal, your home's gone up in value. And so you can get a little bit better interest rate. And so the idea would be to either keep the interest rate you had at FHA or get better and get rid of your monthly mortgage insurance. So that's kind of the strategy there.
Yeah, no, that sounds like an amazing strategy for a lot of people to be able to get into the home when you can, start building equity when you can. Explain what a refinance is for somebody that just has no idea.
So a refinance, you're pretty much just redoing your mortgage. So if you bought a home 5 years ago and you bought it for 500,000, that home is now worth 600,000, and so now you have about $100,000 of equity in there. That's gonna help your interest rate because banks like to see that you have that better gap, and that's what a down payment does as well. So like that, all a down payment does is just bring that difference a little bit bigger, and it's less risk for the bank. So a refinance, you'll just go in and, like, if we got you a 6% rate and rates are now at 5%, we can actually just go redo your mortgage and essentially erase the 6% and change it to a 5%, and it lowers your payment. And you can refinance about every 6 months if you want. Like if rates are coming down and you just went to a 5 but now rates are at 4, in another 6 months we could just erase the 5 and put a 4, and it just redoes your payment and lowers your payment. That's also why it's so hard with how high interest rates are right now, because the interest rate is by far the most temporary thing of the whole process. Like when you're looking at a home, you should kind of be worried about price and if you like it, because those things are a little bit harder to change. But an interest rate you can change every 6 months if you wanted by way of a refinance.
Clarifying just kind of what we've gone over so far then, for someone that does an FHA loan, they have to have mortgage insurance the whole time they're doing the loan, correct?
Yep.
Okay. And then for a conventional loan, it's up to 20%.
Yep. So as soon as your loan, if you take your loan and divide that by how much your home's worth and it comes out to 80% or less, then the mortgage company will actually just drop your monthly mortgage insurance automatically.
So they don't even need to refinance in that scenario. They just automatically take it off.
They just automatically, if you can prove to them that your home is at that 80% or lower level, so if it's at 75% even better, 70 even better, they'll just automatically get rid of it. And you're like, you don't have, yeah, you can just call them up and say, hey, I want to drop the mortgage insurance. They'll do an appraisal and then they'll just get rid of it.
Because I think that's another big question that people have is, okay, if I do have a conventional loan, but I put 5% down, my equity's gone up, and now I am at that 80% value. I don't know if I said that well, but
Yeah, that sounded great.
yeah, how do you get rid of it? And that was easier than I even thought. You just call them up, and they don't even have to refinance. They just do a quick appraisal, and that's it.
Yeah, and a lot of times, I mean, it'll be on your mortgage portal, or you can just reach out to me and I can guide you a little bit better. But I've done it personally. Like on one of my properties, I put 10% down originally, and then after 2 or 3 years, as I paid it down and it went up, I was able to call them up and get it removed. They definitely don't necessarily enjoy removing it because it's that extra payment, but they legally have to. So if you kind of just can push back a little bit if they're being weird, but they legally have to, so that you usually don't have too many issues. But it's pretty slick.
So here's a question that maybe you'll know, maybe not. Once someone buys a home, the mortgage interest is all deductible. So, and
Hmm.
that can be a big tax deduction for people. That can kind of be one of your first really big tax deductions that you have.
Yeah.
Is the personal mortgage insurance or mortgage insurance also tax deductible or not?
So I'm not a tax advisor, but I don't think so. So depending on how you do it, like for rental properties, you can write off your homeowner's insurance, you can write off your taxes, you can write off your interest. If it's your primary residence, I believe you can just write off your interest. So it kind of depends also if it's a investment or a primary, but I think in either of those scenarios, I don't think you can write off the private mortgage insurance. But with investments, there is a lot more you can write off.
And obviously ask your tax accountant. We're not those professionals. We don't deal with that, but I was just a little curious. So another question here for you, are there different types of mortgage insurance? Like are there times that the lender may pay it or it's just a one-time upfront payment? Or is it always just whoever has the loan pays it on a monthly basis?
So there is options for the lender to pay it, but I've only seen it once, and it was like the only way for the deal to work. But rarely does the lender pay it because it obviously is very expensive and costs them money. And I don't even think it was me. I think it was just someone in my office had like a family member that they needed to make the deal work, so they had to pay for that up front type thing. And so he kind of covered that out of his own pocket. But there are different types. So it's kind of funny. There's MIP and then there's PMI. And I don't know why there's two different phrases. But PMI is private mortgage insurance. That's the one that most people have heard of. That is actually the term that conventional mortgages use. Then there's MIP, which is actually the official term for the mortgage insurance on FHA loans. So it doesn't matter if you say MIP or mortgage insurance or private mortgage insurance, it's all the same, but for some reason they differentiate. Here's another little asterisk with FHA loans. Like I said, they're great for getting you into the property. There's less down payment, they're better interest rates, but they also have what's called an upfront mortgage insurance premium. And so outside of the monthly amount, onto your closing costs, they're going to take your loan amount and times it by 1.75%. So on a $500,000 loan, you're looking at about, what is that, 8,500 to 9 grand, 1.75% of 500,000, and they're going to add that to your closing costs. So it's another upfront cost that you'll be paid. Now, what they also how they also get around it is they say this is the one and only closing cost that you can actually wrap into your loan, and the loan can pay for it. You can't wrap any other closing costs into your loan, but this upfront mortgage insurance can get wrapped into your loan, so you don't actually have to pay that at closing, but it still is a cost that's added onto your loan that you're then going to go and pay interest every month on. So a lot of people don't like FHA loans because of that. They are a little, I guess, more costly up front, but with the lower interest rate, it kind of evens out. But as far as different types, it's not like they're different types. It's just FHA's that way and conventionals this way, and those are pretty much the two main programs as far as mortgage insurance, and they kind of just have their own way of doing it and their own percentages that they calculate it with, and that's pretty much it.
So shifting on, I'd love your opinion advice a little bit here
Yeah.
for a new buyer that it might be a stretch to get to 20% down, but maybe they could do it actually.
Hmm.
What would your advice be? Do they make the stretch to get to 20% down to avoid the mortgage insurance? Or do they stay a little more conservative, maybe do 10% now, and then once their equity comes up a little bit, take it off later? Do you have any advice for that?
Yeah, I'm a little biased. I always like to leverage more of someone else's money than my own. So if it's me personally, I would just do 10%. The mortgage insurance is going to be less if you put 10% than 5%, and then even less if you're going to do 15 to 10. But where that drops off at 20, it just kind of depends on the person. A lot of people are very stable and they have a budget and they know that they're not going to be super house poor. So they could put the full 20% and have everything budgeted out and know that it's not going to overextend their savings account. But if they wanted to keep a little bit back and maybe invest it as on the side and just do 10% down, it kind of just depends on the person. But me personally, I would just do the 10% down and then look to either refinance or just get that mortgage insurance removed as your home grows in value. But it is very dependent on the person and their financial fingerprint and their thoughts on finances. But yeah, me personally, I always like to do the least amount of down possible that makes somewhat sense.
That's a good point. You can walk through the numbers with them and help them make that decision if they want to. And just kind of an outside perspective that is a little less emotionally attached. And that's where you step in and is really great in that process.
Yep, exactly.
When your clients come up and are asking questions about mortgage insurance, are there any common misunderstandings that come up or questions that they have?
Not really. I think everyone's aware of what PMI is. I think the stigma out there is it's a lot worse and more scary than it actually is. I mean, and I say that just because, I mean, there's a good chance you're going to be paying it. It helps you get in the home. It does necessarily suck, but I've also come across some buyers that will not, like, they refuse to buy a home if they have to pay mortgage insurance. And I totally disagree with that thought process and mentality because by the time it takes you all that time to actually save up enough for 20% down. I mean, 20% on 500,000 is 100 grand. So however long it takes you to save up $100,000, you're losing out on that home appreciating every year that you didn't buy it because you were worried about the mortgage insurance. And that's a rare case, and I know that like Dave Ramsey's a big advocate of 15-year mortgages and 20% down, and it works for some people, but the majority of people, the best way to build wealth is through real estate, and if that means doing 5% down and then worrying about the mortgage insurance once you've built some equity, I just think that's a little bit better strategy. But yeah, there's not usually any super major concerns. I think a lot of people are shocked sometimes that it can be up in the 200 range, like $200 a month. The FHA is always a misconception with the upfront mortgage insurance as well. They're like, whoa, what's this $8,000 charge onto my closing costs? I'm like, that's FHA. They set it. I have no control over that. I mean, good thing we can wrap it into your loan, but you're still paying that. It's more just kind of a shock factor on how much it can be sometimes. But yeah, it's definitely not a reason to not buy a home. I would still recommend getting in, building some equity, being a homeowner, and starting that process.
Well, I think it's even safer here in Utah where we have such a strong real estate market. We're up year over year over year. We were
Yeah,
talking with Todd last week on the show, and Utah's expected, I think, 3 or 4% increase this year, and
yeah.
then 4 to 7% is what they're estimating for next year. Trying to match those numbers with your savings is so difficult. So I'm also of that opinion that if you can get into the home sooner and start building equity with the market, it's just going to help you long term. Any other last final advice that's kind of on your mind for us today?
Not really. This was a great topic. I honestly didn't think we'd be able to talk 25 minutes on mortgage insurance, but there's a lot to it, and I want to make sure people understand it because it is there and it's obviously very common. 95% of people need to pay it. But yeah, definitely don't let it stop you from buying a home. That would be my biggest thing is there's those 1 out of 10 where they're like, I do not want to pay it. And they are like pulling money out of investment accounts and pulling money out of trust and family accounts. And like you said, the Utah market's strong. I mean, if you're buying a $500,000 home and the market goes up 5%, I mean, the 5% on 500,000 is, what is that? 50,000 that you just made in 1 year. Now, how realistic is it for you to save 50,000 in 1 year when you could just have 50,000 added onto your home value in 1 year? So that's just my final plug. But yeah, if you have questions about mortgage insurance, let me know. It can be simple, it can be complicated. It just depends on your financial fingerprint and your situation.
What's the best way for people to reach out to you if they do have questions and want to talk to you one-on-one?
Yeah, I mean, if you want to put my number and my email in the notes, but I also just have Bentley Advisory Group on Instagram and TikTok, and I have a Facebook, so feel free to go look those up and just message me, but text, email, all of that's great.
Awesome. Yeah, we'll put all your info in the show notes below. Thank you so much for being with us today, Casey. It was a great conversation.
Yeah, thank you. This was awesome.
We're here in Mapleton today. This is the Harmony Ridge community with Edge Homes. This is one of their single family homes. It was actually just showcased in the Parade of Homes as well. So we got an awesome house to get into. Let's jump into it. This is a really special home that Edge Homes has. This is their single family home here, and it was actually just featured in the Parade of Homes. From the front door, we've got a great setup for a library here, and then it walks us into this amazing open concept living room. Vaulted ceilings, connects up to the second floor with the loft area. 3 bedrooms upstairs, primary bedroom here on the main floor. All right, heading into the kitchen here. This kitchen is pretty special. Double ovens, great fridge here, huge island, great sink, dishwasher. I mean, it's got all the basics. I really like the range here. Having it freestanding is really nice to me personally. And then off the back is what is really special about this home. You've got a butler's closet, pantry, whatever you want to call it, with a separate fridge. I don't know about you guys, in today's age, I have a lot of appliances. You know, you have your KitchenAid and you have your air fryer and all of that kind of stuff, and it just takes up so much counter space. That's why a butler's pantry is really nice. It just gives you a place to put all of that stuff. Here we got a great dining room, and then it leads out to the patio off the back. So sliding glass doors there. Off the back here, this is your mudroom. This is where you'd come in from the garage, you know, you have a place for those dirty kids, take off their shoes. You also have a nice half bath in there as well. Okay, we're not even finished with this main floor yet. We're about to take a look at the primary bedroom. This is one of the gems of this house. Okay, primary bedroom here. As we walk in, you're gonna see this thing just keeps on going and going. So you've got great windows to utilize those great views. All right, bathroom. Yeah, it keeps going. It's huge. Double vanity off on our right here. It leads into this huge walk-in closet, space for washer dryer hookups. It's got space for a couch. Coming out of the walk-in closet, toilet, and then you've got soaking tub with a nice view of the valley. And then obviously your big walk-in shower here as well. From this main floor, we're gonna head upstairs, check out the loft area, and then the 3-bedroom, 2 bathrooms upstairs as well. Upstairs, main loft, great nook for games. You can put a TV in here. And again, I just have to point out, being up in the mountains here, it feels like you're on the hills. It feels like you're in the mountains, in the canyon. The views are just amazing. 3 bedrooms, laundry room as well, so you don't have to share with your kids. You've got your own in your room. They've got their own up here. First bedroom here, Huge windows. Again, can't get rid of that view in this house. Have to love it. All of these bedrooms as well have a walk-in closet. That's one thing you don't often find. All of the bedrooms in this house have a little walk-in closet. All right, so that was bedroom number 1. This one's a little bit bigger. This one also has an ensuite bathroom as well as a walk-in closet. All right, continuing on. Right here is just a utility closet, and then we've got a full bath, laundry, and then another bedroom. So you got full bath right here, tub shower insert. So laundry, great counter space. You got a linen closet in the back, and then you've got tons of storage in here as well. So no lack of storage in this house. They did a really good job on that. All right, this brings us to our last bedroom. Pretty much the same as the first one that we looked at. Great views of the mountains, walk-in closet. Okay, so if my math is right, it's 4 bedroom, 4 bath. Not to mention you've got the downstairs that's not finished, so it has so much potential for you to be creative in whatever you want down there. It's about 5,000 square feet. And again, I just have to mention it one more time. These views of the mountains are just killer. You have the full Wasatch Mountain Range here, behind us Spanish Fork Canyon. This is really an awesome little getaway house. It feels like you're out in the hills. Can't be beat. We've been walking through this house, and one thing I just want to point out, main floor living with the primary bedroom on this floor here, as well as the washer dryer in there. This house is a house you're not going to outgrow. This is a place you come and stay. Being here in this community, it's just gonna develop. You're gonna love your neighbors. There's gonna be lots of kids around, and you're just gonna feel at home here in this place. Thank you guys for watching this episode of The Dirt on Real Estate. As always, if you have questions about real estate here in Utah, or if you're looking to buy or sell in Utah, please reach out. My number and email are always in the show notes below. But that's it for this week. Tune back in next week for more dirt.